Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. U.S. consumers are on track for a record year for debt repayment before the coronavirus pandemic, according to personal finance website WalletHub. But those projections have now changed. Jill Gonzalez, communications director at WalletHub, joins me to discuss. Jill, welcome to Trade Talks.
Thanks for having me.
All right. Now, how did consumer credit card debt fall when so many people are actually out of work?
So these are quarterly numbers. So the most recent data available is going to be from Q1 of this year. So really before the coronavirus pandemic started to affect health rates, started to affect obviously unemployment rates. And that's something that we've seen usually in Q1. That's where we see the biggest pay down of any time in the year. You'll get your tax refunds, you get your end of year bonuses. So that's where we see the biggest pay down. And this year was just something that we haven't seen in almost 20 years. It was 50% higher of a pay down. So that's what makes all of what is happening now and what happened after that much more crazy.
How has the first quarter credit card debt pay down affected people's ability to withstand the coronavirus shutdown? It's got to be a blessing in disguise that the pay down was more substantial than anything you've seen in 20 years to help people weather the storm.
Yes and no. I mean, yes, definitely a blessing in disguise in that at least now they have less recurring debt that is racking up more and more interest that they will eventually have to pay off. The other side of that is this, if we knew what we knew now, if we knew that in 3 months we would actually need that money just to keep our family afloat, to keep up with rent or mortgage payments, rather than putting extra money toward a debt payoff, would that have changed things at all? Would people be able to weather the storm in a more of a short-term way now? So I think it goes both ways. I think for certain people, it definitely was a blessing in disguise. I think for others, they might be wishing that they waited even longer so that they had some of that short-term cash available to them now.
What can we expect from credit card debt levels during the rest of the year?
Well, like I said, we were on track for probably one of the best years in terms of a debt pay down that we've seen in almost 20 years. Now that is definitely not going to be the case. Since 2018, we've consistently racked up about $1 trillion worth of debt as consumers every year since then. This year, we might not hit the $1 trillion mark, but we're still on track to rack up a net of about 60 to 80 billion dollars by December. So we're no longer looking at a great record year for us in terms of payoff. We're looking at, at what is typically a normal year that we've seen for the past few now.
That's still a high number, 600 to 800 billion. While it's not quite that $1 trillion number, that's still a lot considering we have 40 million Americans plus out of work. So what are your tips for paying off credit card debt and managing the best that you can?
Well, there's a couple of different strategies here, especially when it comes to credit card debt. The one thing to keep in mind is that, and this is a question we've gotten a lot, is which debt is important right now? Which do I need to be paying off? So obviously talk to your creditors, see what they can do to you. Talk to your mortgage providers. Banks aren't really budging there. Rent is a little bit more flexible, but credit card debt is not going anywhere. Even if you are getting forgiven some missed payments, or if you are getting your interest rate lessened for the time being, which is what some banks have been doing, it's still going to be there at the end of the day. So there are really two strategies in how to strategically pay off your debt rather than just sprinkling any money you have across all of your different credit card bills. Really go after one that you can keep track of, pay the minimum on everything else. And that can be either your lowest balance, so you kind of get done with that the quickest, maybe motivate yourself a little bit more. That's called the snowball effect, little by little. Or you can do what's called the avalanche effect and go after your highest interest rate first, maybe not your highest balance, but the one really costing you the most money at the end of the day. Tackle that first and then move on to the other. So then you'll be easily able to track your actual payoff.
All right, Jill, thanks so much for sharing the insight.
Anytime, thanks.
All right, and thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.